Welcome everyone. This is Drashti and I am part of the business partnership team at Dhan. Thank you for taking out your time and joining us for today's webinar. Wait for another 2-3 minutes for everyone to join in. Okay, so let's get started with today's webinar. Today's webinar will be conducted by Ashwini sir. He will be teaching us or will be taking us through basics of scientific investing. A little housekeeping before we start the webinar. If you have any questions during the session, please type them in the question box or I'll bring them up during the end of the session. I'll quickly give you a brief about Ashwini Kumar Shami. Ashwini, co-founder of OmniScience Capital, will be bringing us to bring scientific investing to global markets. Ashwini leads advisory and investment management activities at OmniScience Capital. He brings in 15 plus years of experience in the financial service industry. Earlier, he has worked with Goldman Sachs as equity research analyst. He has a BTech and MTech. He is a BTech and MTech from IIT Bombay and earned his MBA from IIM Lucknow. As I mentioned earlier, today Ashwini sir will be taking us through the basics of scientific investing. Over to you, sir.
Yeah, hi Drashti. I will just bring up a presentation. Okay. So I hope the presentation is visible. Very good evening and thank you for joining us this evening. Thank you so much to the Dhan team as well for giving me this opportunity to interact with you today. As you all know, the topic for today is scientific investing, which is the proprietary framework that OmniScience Capital has developed, and this is what goes behind creating all the investment offerings that we have. And this basically helps us find great investment opportunities. And I'll get into in the later part of the presentation how and what kind of investment opportunities that we are seeing right now. And so let's dive in, let's get started. So this is important for compliance and regulatory purposes. So this needs to be captured here, but let's move on. Okay, so before we get into any details, the important thing is to understand Omni Insight, right? Because everything else that I'm going to talk about comes from Omni Insight. And that's a big differentiator, I would say, when it comes to creating investment products. And so, yeah. So what we have seen is that when it comes to equities, a large number of market participants, whether they are professional investors or individual investors, they chase alpha, or in other terms, नॉर्मल भाषा में बोले तो एक्सेस रिटर्न या मार्केट से ज्यादा रिटर्न जनरेट करने की कोशिश करते हैं सब लोग, और उसको करते हुए they end up getting risk, right? So they buy companies where they lose capital, they end up buying companies where they had a very bad experience of equity markets, and then they think that okay, this is very risky, and so obviously this is a risky asset class, and that's where the importance to focus on safety becomes paramount. So what we have learned over years, over decades, is that equities returns are anyway, if you compare it with any other asset class, these are one of the best returns. Right? Now, when you come to equities, returns is something that you should not and you need not focus. Right? What you need to focus on is actually safety, because you are playing in a risky asset class. And when you focus on safety, and how you do that and all those things and what does safety mean, we'll cover during this discussion. But if you focus on safety, the returns or the excess return, the alpha, becomes a byproduct. So you don't have to really worry about that. That becomes a byproduct, right? So this is the Omni Insight. We have to keep this, at the back of our mind all the while when we are, investing in any products and making equity investments. So this is extremely important. Now, obviously, it has a long history, a 4-decade-long history, where how we have come about this Omni Insight. But this, I'll not get into the details. But there's a long process of creating the scientific investing framework, which basically are 2 decades of research. But we have gone back and studied 100+ years of investment management history. And obviously, when 100+ years, then US is a market where you have to go. And there have been many great investors, right from Benjamin Graham to Buffett, his partner Munger, Phil Fisher, and so on. So we have learned from all the greats, inculcated, their points or their understanding of, how markets work, how to evaluate companies, how to create portfolios, and so on. And based on that, we have built this scientific investing philosophy and the framework. Now, just like getting into more details, let's see what is scientific investing and how do we apply it, or how anyone can apply this when they are creating an equity portfolio or investing in the markets. So this is basically a 2-step process in a way. Right? One step is you're trying to enhance safety, right? That's where I already talked about that. How can you target extra returns is by focusing on safety. Right? So that is one element. The second element, which is enhancing growth, where I will come next. Right? So let's look at this. What do we mean by enhancing safety? Right? So when we start creating a portfolio, when we want to invest, so you can invest in the full market. That's obviously an option. You can look at, and that through ETFs, that's possible these days, buying, let's say, all 500 stocks or all 50 stocks of Nifty 50 or Nifty 500 index. But what we believe is that when you start from full universe, let's say top 1,000 companies in India, or let's say top 500 companies, There are various types of companies which create risks to your investment. So this is what eliminating or mitigating, those risk factors is something. This is how you enhance safety, right? So let's understand broadly. Like we cannot go into details of how and how you really do it. Like broadly, the concept, if it is clear, then you will understand. There are three types of companies that you need to stay away from. So सबसे पहले है capital destroyers. So these are weak businesses, cash flow weak hai. The companies have taken too much of debt or leverage or loan, whichever way you understand, and they are basically, they have created a risk which at some point will manifest, or shareholders will lose all their capital, right? Whatever money they have invested, and that potentially will go to debt holders, and debt holders, whatever they can recover from the asset, they will try and do that. So these are very high risky risk companies where in a snap you will lose most of your capital. This is something that you want to stay away from. So we try reduce these companies, poor cash flows, companies which have huge unsustainable debt, and companies which have weak business model. Right? So this is something you want to stay away from. The second type of companies that create risk in your portfolio are what we call as capital eroders. Right? So essentially, what these are, like, they are poor return generator, right? As a business, not the price return. I'm saying that the business, the return on equity, the investments or return on capital employed that the company has put in, it is actually not generating sufficient return to meet even the cost of capital. So that is something eventually, like no matter how long you hold on to this kind of a company, eventually even over a longer period, you will end up losing money. Right? So again, we don't want to invest in such companies. Again, you want to take them out, reduce as much as possible. Right? The third risk factor comes from what we call as capital imploders. Now these are fundamentally very good companies. They're so good that market actually loves them, and they basically become overvalued. And when you start paying too much, then you obviously run a risk of buying something which is beyond its, let's say, real value or intrinsic value. If there is something worth 100 rupees, if you have paid already 150, just because it was going up, there is always a risk that okay, someday it will come back to 100 and you will lose money. It might continue to go up, and that's where you are hoping that isme thoda paisa ban jayega, but that is not a sustainable investment strategy. So one news where market company is deviating from what the market expects, or uska price implode ho jata hai, and that's where you, as a shareholder, as an investor, you will end up losing money. So you want to stay away from these companies as well. So when you clean up these type of companies, what is left is all fundamentally good companies, high return potential in terms of fundamental return. So competitive advantage has some companies. And finally, you're not overpaying, right? So you have bought them below intrinsic value or at max, you're at a fair valuation, right? So this remaining pool is something what we call as capital multipliers. Now the second steps come in where what you do is basically you focus on growth factors. Right? So now you are left with all clean up universe where companies are all fundamentally good. Now you want to, when you are creating a portfolio, you are selecting a subset of that capital multiplier universe. You want to tilt your portfolio to have certain exposure to high growth companies. Right? Now that is one parameter, but that growth has to be a secular growth, a long-term growth, right? A mid to long-term growth. Just growth because of certain short-term parameters like COVID, so company dealing in mask or PPE kit, suddenly their growth went up. That is not something which can be called a growth sector, right? But something which is a sustained growth opportunity will become a growth sector. And more importantly, it should remain, like when you identify it should remain in the blind spot of digital market. Right? So because if it is already identified by everyone, it has become overvalued, and then you are not going to generate some supernormal returns after that. Right? You will have market returns at best. Right? So that is that's what you need to keep in mind. How do we do that is something different, significantly different from, typically, like, when people talk about growth and people talk about, let's say, themes or market segments which are expected to grow, they do a top-down approach. And problem with that is, you might like the, overall concept that, okay, this particular thing might grow fast. Lekin you have to understand that are there sufficient companies in that particular growth vector where you can invest. You need to understand that are they available at reasonable valuations, right? So you need to have mispriced multiple such companies. It can be identified only with a bottom-up approach, and they need to have a robust long-term future, and they should have shown some kind of capability to that they can capitalize on that growth. In the past, they should have shown some historical growth trend, and us tarah ke multiple such growth vectors is what you need to include in your portfolio. So that's basically kinds of summarizes the scientific investing framework. Focus on safety with reducing all kinds of companies which can potentially erode your capital, and then tilting your portfolio to high growth vectors or set of segments which potentially are exposed to some kind of sustained growth trajectory in the mid to long term future. So that's what scientific investing framework does. Now, many people ask that, okay, how is it possible, right? You're talking about all good things, like all fundamentally strong and still mispriced and still in the blind spot of Mr. Market. So that happens. There are market anomalies. These are different types of patterns. This in itself is a separate study, but we have listed here, which we see in the market. Mispriced growth is one, which is quite common. Transformational arbitrage, companies, businesses going through some kind of a transformation, and especially in this digital world, this is quite evident. And there are, like, so I'm not getting into these, but this is a separate discussion. Maybe sometime else we can kind of spend time on this. But because there are reasons, because there are anomalies in the market, so you can still find kind of mispriced growth opportunities which are still fundamentally strong. So this first part is to kind of cover what scientific investing framework generally what we talk about. Now let's go to the more interesting part of the discussion. Now, how do we uncover hidden investment themes, right, using this particular framework? And let's say when we have applied this framework in today's market condition, what are the various growth vectors that we are seeing? And based on that, we have created our investment offerings, which are available, for investors using Dhan small case platform. And so I'll talk about few of them here. There are multiple such offerings, but I'll touch upon a few interesting opportunities here. So सबसे पहला जो growth factor है, that is around railway infrastructure. So Omni bullet train small cases there and gives exposure to the companies which are exposed to this particular growth factor of railway infrastructure. Now, there's a huge amount of massive investments that are happening, unprecedented. There is, estimate of around 50 lakh crore to be spent in next few years, right? So not very long, let's say next 10 years or so. And you can get a sense of it by the gross budgetary support that the government is working on, right? So this year for 23-24, 2.41 lakh crore is the GBS gross budgetary support that is provided in the budget, right? Now contrast it to let's say earlier era, let's say roughly 10 years back, this amount was a meager 20-30,000 crore. It is nearly 10 times more, right? So that is the kind of investments that are happening. Apart from this, there are funds raised separately for investment purposes, and the total outlay on capital investments is expected to be in excess of 4 lakh crore this year itself. So it's a very, very clear focus area. And when I say railway infrastructure, interestingly, there are multiple sub-growth vectors that are there, here. So obviously, the one is bullet train, a lot talked about. It's a very prestigious project that is there. Uh, 500-kilometer kind of total length between Mumbai and Ahmedabad. Uh, it is at advanced stage of construction. Nearly 50% of the civil work in the Gujarat segment is already done. Overall, the project has kind of seen 25-26% completion today. It's a huge 1.1 crore, a lakh crore of investment that is there. Right? But it expects to increase or develop the whole belt of multiple cities that fall in this route. So that's a very prestigious project is there. Apart from that, there are indigenously developed 400 Vande Bharat trains that will be included in various lines in all over India. Now, this is a significant milestone. Right? These trains are 40% cheaper than compared to a similar train, a semi-speed, semi-high-speed train imported earlier, which are imported from outside India. They are significantly cheaper, right? 40% cheaper. So not only it enables government to launch large number of such trains, right? So there's a plan by 2025-26, around 400 Vande Bharat trains will be launched, and we have seen advanced stages of orders being given out, and already 16-17 Vande Bharat routes have been opened up as we speak. So these trains run at around 160 km per hour. The next stage, next development stage, they will be taken to 200 km per hour. And you can imagine, like in India, where typical distances between cities is around 500, let's say 1,000 kilometers. If you achieve 200 km per hour, the connectivity improves significantly, and that you can imagine the whole grid now connected extremely smoothly by having even 200 km per hour kind of a train speed. So there are work going on in terms of improving the rail tracks to kind of support that kind of a high speed or a semi-high speed train. So that is significantly positive. Already the production plan is being laid out, right? So right now it looks a large number, and we will question that where these trains will come from. Right now also we are producing around, in 8 days we are producing one Vande Bharat train. And it is being produced only at one facility right now. It has been like 3 more facilities have been added. Many more companies, JVs have been awarded contracts to produce or maintain Vande Bharat trains. And it is expected like in next few months or maybe quarters, our production speed will go to 3, one Vande Bharat in 3 days. Right? So that is the kind of massive production rate will be achieved. And that's how, if you have to launch 400 trains in next by 25 or 26, that is the kind of manufacturing speed you need. The interesting part is that after 25-26, the government plans to export these trains, right? So I already talked about how, and they are very 40% cheaper. So there's a huge export potential for all these companies who are involved in these, production of these of the Bharat train that is there. So there's the second sub-growth vector. The third sub-growth vector is about the station redevelopment. So there is a focused, separate company has been formed, which is basically a partnership of Railway Land Development Authority and some other companies, and they are planning. The government has planned around 1,275 stations to be redeveloped in next few years. So that's a massive amount of capital expenditure and modernization and upgradation of the whole railway infrastructure. And this is not very far. Like already, as we talk, more than 40 stations have started the redevelopment plan. Project worth 13,000 crore have been already given out to various entities. and it's being done at a massive scale, right? And you would have seen some of the photos or plans circulating for, let's say, New Delhi railway station or Mumbai railway station and so on. They are going to be mega projects, right? So just between Mumbai, Delhi, and let's say Ahmedabad, the capital outlay on the redevelopment is expected to be significantly higher than 10,000 crore. So 15,000 crore is the kind of outlay. And they are basically being modeled as commercial hubs for every city. So just for example, like in Delhi, they're going to create 50 acres of commercial hub in and around the railway station. So that's the kind of they'll become basically the the commercial point or commercial hub, and they're working on improving the access, improving the amenities, and so on and so forth. So that's a great opportunity. There's a huge pipeline that is available in terms of number of stations that we get. The third or maybe the fourth growth sector is on the freight corridors and the total modal share, right? So right now, railways modal share on freight is around 27-28%. They plan to take it to 45% by 2030. In fact, they have a plan, intermittent plan of 2027. What they are calling as Mission 3000 is to have a loading capacity of 3,000 million tons by 2027. So don't wait for 2030. You achieve something before 3 years before that. So even there are certain misses, then you can cover up in the next 3 years. So that is a kind of and that is very significant for railways because 75% of their earnings come from freight, and so that's what they are trying to target. And it is not only that it's good for railways; it is good for broader economy as well, right? Because right now the modal share is tilted towards road, which is basically an expensive way of managing the logistics of the country. If you shift it to railways, right now the freight cost is around 14% of GDP. It will come down to 8 to 9% just by shifting it to, like, if railway captures 45% of the freight share. So they have ordered around 84,000 wagons, which is in India the largest order, and probably globally it is one of the largest orders of wagons. And that's the kind of pace that things are moving. And finally, many modernization. So metro trains, you know about, like 30 plus cities. There's massive amount of massive network of metro trains is being developed. There is electrification, right? Now, electrification itself is like we have nearly achieved 90%, or by the end of next year, we will achieve 100% electrification of the broad gauges. And that's a landmark in itself. Like globally, the electrification is only around 30%, but we have achieved 100% electrification of the railway lines. So that helps us, get more green in terms of consumption, like moving away from diesel and so on and so forth. So it's a very dynamic, very attractive space. On the fundamental side, I always will tie it back to the scientific investing framework. How we identified it? We identified these companies because they were fundamentally strong. Debt was zero. So cash-rich companies, margins, ROEs significantly higher, or even if it was low, it is on a trajectory where the ROEs are actually expanding or improving. Huge TAM, so there is kind of endless growth opportunity. Companies in the portfolio have typical like 2 to 5 times of their current revenues as order books available to them. So there is no lack of visibility of of where the orders are going to come from next year or in next few years. And this is available cheap. Right? So certain numbers are given. You can look at those things, but it's significantly cheaper even on the trailing 12-month basis. If I kind of projected 2 years, 3 years, if I project the earnings 2 years, 3 years down the line, and then look at the multiples, it will be really, really cheap. So this is one great opportunity or great growth factor that you can look at. Moving on, digital transformation, OmniDX is another growth sector. Is around the IT services companies. Now they are exposed to the digital transformation as a, now it is quite common in the sense it's quite popular. But let's say 3 years, back, people found it difficult to really understand, okay, how these companies in this digital era going to survive or create value for investors. And very marquee investors had on record said that, okay, these companies should not act like startups, they should act like oldies and so on, which is something was completely different. We clearly saw that there is a digital piece in every IT services company which was growing at a very fast rate, and it was smaller, let's say 3 years back, but now it has become significantly larger and the overall growth rates have come up. Right now, it is facing some challenges from the US economic perspective because they end up exporting a lot of services to the US. And US in, because of the interest rate cycle is, there are fears of recession, which so far we have not seen, but maybe, you expect some recession to come this year. And because of that, people expect that IT spendings will be cut. But we have a different view. We think that this is only a blip, while the longer growth opportunity for these companies are very, very strong. And specifically because of the kind of underlying projects that these companies are doing. Right? They are essential now, right? Cloud migration, having a digital UX, using automation, using AI, or things like that. So that is now becoming mainstream. So you can imagine that if things are becoming mainstream, a lot of companies, Fortune 500 companies, globally companies will end up using this, and they need a lot of handholding. Right? If I want to implement, let's say, something like a Chat GPT for my business, I need handholding, right? And where these companies come into the play. When if I need to migrate to cloud, I need handholding from these companies. If I need to automate a lot of processes using AI, automation, machine learning and things like that, I need support from these companies. So the growth opportunities are immense, and it's only a blip, and you're getting these companies now at attractive valuation. So this is something really, you can look at the fundamentals. Margins are significantly better than the market. ROEs are significantly better, and you're still, paying less than the broader market, right? So this is where the attractiveness is. Next is defense. So defense being one of the best performing strategies over the last year, and rightly so, because frankly, this sector was not there, you couldn't have invested in defense in India 5 years back. Right? So a lot of companies got listed, broader market, the focus came around, of being self-sufficient in defense and exploring the export market. So obviously, we are one of the largest spenders in the world, and we have set some great, kind of targets for 2025 in terms of being able to produce 1.75 lakh crore of achieve turnover of that size, export something in the range of 35,000 crore in the next year. So this all gives high double-digit growth numbers. But essentially, it's important to understand that why, as an investment opportunity, it has a good long-term growth. Right? So typically, the defense budgets are budgeting is done as a percentage of GDPs, right? So India right now is around 2%, 1.9, but it is expected to go to 2.5. That's what we have maintained over in the past. But still, a significant part of that budget is going into capital equipment creation and so on. Second is, so obviously as India's GDP grows and we expect to grow it like at a good rate. So nominal double-digit growth rate is expected. So that becomes the de facto growth for the defense budget. Second is we are focusing on indigenization, right? So whatever we wanted to produce or whatever was imported now is expected to be locally produced. And third point is on the exports. So the export market was unexplored, let's say. Right? There were companies which were doing this were not even focusing on export at all. So the companies which have unique capabilities, right? There are companies who can make stealth submarines, aircraft carriers, combat aircraft, fighter jets, missiles, and whatnot, right? Now, these are unique capabilities globally, right? A handful of companies can actually do this. Now, this is something that Indian research houses and these kind of monopolies, I would call them, had that capability. Now, it's very interesting that if you just explore the export market, there's a huge kind of TAM that opens up, right? So India, maybe there are government has sent identify some 80, 90 countries for, and they have sent defense attaches, 91 defense attaches have been sent out to these, and they have created a single point, kind of a interface where countries who have certain kind of needs in terms of defense equipments, so they can come to that particular interface, and then between intergovernmental discussions can happen, and all these companies come together and provide. So we have been seeing that defense expos have been held every year now, right? So, and it is a lot of companies are signing MOUs, getting orders in those expos. So the vibrancy is evident, and that's why the opportunity here. Again, fundamentally strong, valuations are attractive, and this is still a growth factor which is identified by Mr. Market now to a great extent, but not completely, I would say. So there is a lot of steam left here. Now moving on, OmniPower. Right? So power itself is a great investment opportunity, and this is like one of my personal favorites because conventional hai, but फिर भी great opportunity in terms of growth. Right? So government estimate by 2030 that we will need 4 trillion units. Okay. वो itself works out to be current जहाँ पर हम 1.75 trillion units जो consume कर रहे हैं, that comes around 13% kind of a growth rate in terms of volume growth, right? So it's a volume growth itself is that. इसके बाद एक tailwind आता है EVs की वजह से, right? Plus electrification of railways जो हमने बात की, many more Vande Bharat trains and so on, which are higher capacity. Freight requirement बढ़ने वाला है, right? So all the transportation which was expensive on roads through vehicles and trucks which were running on diesel will basically shift significantly to Vande Bharat trains or other freight trains, and they will run on 100% on electricity. Right? So there are in next 5 to 10 years you can visualize जैसे EV की only because of the EVs, right? We expect that nearly 500 billion units more will be required, and that's a very conservative estimate. So that is another growth because of logistics, the energy that will go into logistics. That is another big. So effective volume growth will be significantly higher. Right? So that is one ground up way of looking at it. और एक तरीका है, typically we don't like that approach much, but फिर भी just for the discussion sake is per capita consumption of electricity, right? So India में अभी it's around 1,000 units per year, right, per capita. But any developed country, if you look at, or even for that matter, China, it is close to 6,000 units per year. Right? In a country like US, it is around 12,000 units per year per capita. Right? So when India is moving towards being from a developing country to a developed country, which is, given the current growth rates of the kind of capital investments that are happening around us, हमने कुछ, we have covered this in separate videos, and you can look at that, what are our estimates of India per capita income going up, and India getting into that, from a low income to a mid income and then high income group. So obviously the consumption of energy will also go up, at per capita level. So that's also another way of looking at that, why there will be a huge growth. So that is one part of which takes care of the growth, capacity building, and so on. On the other side, like if you look at the companies which are going to be nodal agencies in doing this or creating this, then very interestingly, most of these companies are available extremely cheap. Right? You can look at the PE number, compare it with the market, and it's significantly cheap. While fundamentally they are very strong. A lot of numbers might look low, like a ROE might look low at 11.7 versus for at a portfolio level. These numbers are at the portfolio level. It might look low, but the thing is that there is a lot of capital work in progress, right? So there is a generation company, for example, which is a hydro power generator. Now, nearly equivalent amount of its current operational property, plant, machinery, it has invested in working capital because these are longer, projects. It takes time, right? So a lot of these in work in progress capital will come into play in the next 2 to 3 years, and that is where you will see a lot of growth in terms of numbers, top line numbers, and all that will come around. So from a top down and as well as from a bottom, both side, the story adds up to say that okay, the growth will be strong, and you are getting this today at very, very attractive valuation. Right? So that's the definition of growth vector. Right? Now moving on, so I think there's only 5 minutes remaining, but we want to take few questions also. So let me rush into last couple of growth vectors. So capital enablers, it's very interesting. अभी इतना सब investment हो रहा है, अभी मैंने बात किया on various growth factors. Who and how are you going to fund that, right? So our estimate is that nearly 200 lakh crore of investments will be required in the form of debt and equity. Now this will be done by the whole financial services ecosystem, right? Whether it includes so there are certain specialized NBFCs, which take care of railway infrastructure or housing or urban development or so on and so forth, or power projects and so on and so forth. And then there are generic banks, right? So NBFCs, banks. Now around that there is a whole ecosystem of rating agencies, exchanges, and specialized fintech companies. They will all benefit from this huge 200 lakh crore kind of fresh capital creation that is going to happen. So it's again strong growth, strong fundamentals. Debt is not an issue here right now. The books are clean. The ROEs are improving because of our bad loans, and everything is now getting cleaned up. So it's a very good. Last couple of years we have seen the credit growth has taken taken an uptick. Even the loan growth will be strong even from so far a lot of investments are coming from the government sector, right? But even the private sector is now responding, right? Because we have seen that the asset utilization, right, so is improving, right? We were struggling at 55-60 for a long time. Now we have hit 80-85% kind of asset utilization, where now fresh capex cycle will also get unfolded, and that creates additional kind of supporting growth pattern for this growth sector. So this is another opportunity, interesting opportunity. Future of mobility, EV and beyond. So this is a very interesting portfolio, which basically kinds of visualizes that, okay, next 10 years, how in India, goods and services, passengers will be transported from one point A to point B. Right? So it's not limited to EV. Yes, EV is a significant part of it. We try to capture commercial EVs, two-wheeler EVs, passenger EVs, battery technology, charging infrastructure, and and power creators, right? Power generator. So that is something people forget when they talk about EV, but then that is a huge growth factor. Because of the EV, there is a significant amount of power that will be required. Right? So all that is there, but then railway is working strongly on the modal share to grab the modal share, right? So that is part of it. And then we have also covered waterways, airways, and how, so it's the right now the portfolio may not have many companies, but the universe, or the where the portfolio can pick companies from, it takes care of all kinds of modal, all modes of transportation into consideration. So wherever there is opportunity, it will go and create a portfolio around that. So it's a significant opportunity, again, very interesting. And finally, I think there is one product which is something like a flagship, which we brand as Super Stocks, is a flexi cap, but it basically covers all, right? So one can take investments into all these different growth factors. That is one way to go about. And if someone says, okay, that's fine, there's too much, then I just want one single investment, then this is it. Right? So it gives you exposure to DX, power, bullet train, capital enablers, EV, and everything. Right? So that is one. Yeah, so that kinds of I want to conclude with this. Obviously, we are doing a promo here, and we are offering 40% discount on 6-month fee on all fixed fee small cases of OmniScience Capital. This will remain valid for, I think, few days, around a month's time. So make good use of this, and enhance your returns by reducing the cost for at least for this period. And that's all from my side. Thank you so much. And if there are questions, then I'm happy to take questions.
Thank you so much, Ashwini sir.
Yeah.
Yes, there are a few questions that are there.
Yeah.
It was a very insightful session that we had, and I was just about to announce the discount coupons for all our attendees which are there. I'll quickly add those on. I have wrote in the chat as well regarding the discount coupon which is there, which is Dhan 40. Sir, we just had a question regarding how has technology influenced the field of scientific investing, and what are the new opportunities or challenges that it has created?
Yes, so technologies play a very significant role because of two reasons. One, that when you are investing, right? So talking about let's say the scientific investing framework itself, right? There's a constant endeavor to find investment opportunities from across the market, right? So when we say, our starting universe is top 1,000 companies in India, right? All companies more than 1,000 crore market cap, right? And that's a large universe to kind of really identify, go into in-depth analysis of that. That's where technology becomes important as a tool to help you to do investment research or investment management. And but so that is one part of it, right? And then there is a active part of it, or where you are focusing, or you are bringing back those concepts that that scientific investing talks about, of risk, being a risk aware, staying focusing on safety and things like that. So that is done through a technology, where using a lot of analytics and things like that. A lot of human or computer power to run programs and run models, and then digging in and identifying that, okay, where the future lies. And so that's a hybrid of I would say technology and a lot of investment wisdom that is there out there for anyone to kind of go and pick.
Thank you so much, sir. That was a very great explanation that you gave. There is another question which is there, which is how do scientific investors account for factors such as market volatility and economic uncertainty when while making the marketing investment decisions?
Sure. So see, the market volatility is something that we are actually not too worried about. Okay. Uh, that is described as risk. Okay. We don't believe that is risk. That is the nature of the market. So if you invest in the markets, your portfolio will go up and down with the market fluctuations and gyrations, and you really don't have to worry about that. If you can't digest that volatility or that market going up and down, then you shouldn't actually try out in equity investment. That is given, right? So that actually gives you opportunities, to buy companies, when they are down. Then, like, I talked about DX, right? So that's a opportunity now to buy some great companies at very, very attractive valuations, right? So that is something, definitely, is part of the game. As far as economic uncertainty is concerned, right? Now that is something the scientific investing process is designed to, so what we do is like, uh, we focus on companies which are fundamentally strong, right? So balance sheet strength is something I talked about, right? Now these companies are actually, running their operations in a way that, even if there is a huge amount of uncertainty that comes, right? For example, let's go back 3 years and talk about the COVID scenario, right? And that was a time where there was complete economic or any kind of uncertainty, existential uncertainty was there, right? So that time we looked at these companies and saw that, okay, which companies are actually going to face a lot of trouble, right? Because they have to shut down their operations for months or quarters. We had no idea, right? And we looked at that companies actually were, because we focus on lower debt companies, so they didn't have fixed commitments going on, right? So companies had cash flows or cash-rich balance sheets that could sustain them for anywhere from 6 months to 18 months, right? Without a single rupee of fresh revenue coming in, right? So the whole process is basically designed to survive through the uncertainties, but also thrive. Like, like DX digital was an uncertainty, so they really thrived on, these companies thrived on, that uncertainty and created business out of that. Right? So that takes care of the both scenarios that we talk
This would be the last question that is there, which is how can individual investors incorporate scientific investing principles into their own invest strategies? And what could the resources be used, available resources that could help them to do that?
Yes, absolutely. Like I talked about the basic parameters. Anyone who has a basic understanding of finance and accounting standards and accounting principles can understand, when I say that, stay away from companies with poor cash flows or high debt, then you can apply your own set of ratios, right? Companies, when I say you stay away from overvalued companies, then you can use any set of, let's say relative valuation or a DCF, or even if you don't know that much, but you need to have that kind of basic understanding of, how relative valuation works, for example, right? So that much understanding is required if you are trying to create your own portfolio. But don't get swayed on, what is there on news channels or what everyone is talking about or writing about, because if everyone knows about it, definitely it is either overvalued, right? Or there is no extra return that can be created in that. So focus on the very, very strongly on the fundamentals. Uh, Fundamentals, like, that, which are stronger businesses, which have strong balance sheet strength, which have not taken a lot of leverage, which are available cheap. So that's very intuitive once you start thinking, as a, in that framework, and that's all you need to apply, right? And when you see, when you have taken care of, whatever can make you lose capital, obviously you have tilted yourself towards some bit of alpha. And that's what actually plays out. But you need to have a longer horizon. Patience is very important. It takes 3 to 5 years, and you have to continuously monitor. Right? It's not that I have created a portfolio today and then I can buy and forget. Especially in today's environment, economic conditions, you cannot. Right? You can't afford to do that. So very regularly, quarterly basis, you need to review what you have bought. If it becomes overvalued, you have to get rid of it, find something else, and things like that.
Thank you so much, Ashwani. It was a very insightful session. I hope all the users learned a lot today, including me.
Thank
I,
you.
I got to learn a lot about scientific investing, which is there. And yeah, I have already shared the good news to all the users. You have also shared that there is a discount for all the OmniScience Capital small cases, which is the code for that is done40. And if anyone has any queries regarding the session or any doubt regarding in scientific investing, I have shared you the link for our community. You could reach out to us over there. Twitter is also there where you could reach out to us. Email chats and everything is available to all our users. That's all for today. Thank you so much, Ashwini.
Thank you. Thank you so much.